Ladies and gentlemen, welcome. It's my pleasure to welcome you all to the first of our Learn and Lunch workshops for this series of the financial year, and it's brought to you by Virtual Financial. My name is Paul Jansz, and I'll be your host. Probably the key to these sort of virtual workshops is to provide you with just continued learning opportunities. Certainly, Adam, it's been Adam's goal, I suppose, to continue to educate and continue to provide you with content. So that's what we're going to be doing today, probably over 30, 35 minutes. If you haven't already seen some of the stuff we've been doing, I just want to touch on that as well before we get into today's topics. And hopefully you've been able to see through our social platforms, or if you haven't, I'm going to tell you very quickly about what we have been doing. And that is, we launched the Talking Numbers podcast series. And we've done two. We've done Talking Numbers Property Plus, where I've had the pleasure of chatting to a property expert all about property investing. And if you know, us as Australians, we always want to buy our first homes and continue to invest in property as well. So that's been a great little podcast series that we've been running. And we're going to be soon releasing the one I've done with Adem as well it's called Talking Numbers Investment Plus. So look out for those two, wherever you go for your podcast, whether it's Spotify or whether it's Apple Podcasts, wherever it may be. If you typed in Talking Numbers, and you would see Property Plus and Investment Plus. So they'll be coming to you soon. Let's get into today's show. Let me introduce you to our guest. First of all, we've got our CEO from Virtual Financial, Adem Becirevic. How are you?
Great, mate. Great to be here.
Good to have you. And you've got two special guests there. You've got Rob Coyte, CEO of Shartru, and Clint Christoff as well, one of Shartru's investment managers. Mate, I might, gentlemen, how are you? Although, Adam, I might just leave you for 2 seconds to introduce your relationship with Rob and Clint.
Thanks, Paul. Yes, look, I've known Rob for a few years now. I joined the group a couple of years ago. So at Virtual Financial, we have to have obviously a financial planning, a licensee behind us. We've got Rob, who's the CEO. We've got Shartru Wealth, who've got some fantastic kind of investments, products that we use. They look after our compliance. They do a fantastic job. You know, we've got, they also own the investment team. They've got a big investment team. Clint's part of that, so is Rob. So it's really, you know, as a financial advisor, my job is to make sure that we get the structure and the plan in place for our clients. And behind me, the engine room, I have, you know, Rob and Clint, and the investment committee, making sure that the MDA and all the investments we do for our clients are great.
Brilliant.
Yeah, g'day Adam, g'day Paul, good afternoon all.
Good to have you guys here. Good to have you guys here. And I think what we'll do is, because we've got a little bit of we've got a series of different things we're going to work through, and I'll probably leave it with Adam to sort of put his little spin on it, and then for the extra layers, allow Rob and Clint to jump in as well. So I think that's what we're going to work through today as we keep you online for about 30, 35 minutes. Now, just a few things we're going to run through. So let us run through some of the key things we're going to talk about in the next 30 minutes. We'll talk about CPI, where it is at present and why. We'll talk about cash rates, fixed interest rates. We'll talk about Aussie shares, international shares, property, managed funds. We're going to touch on bonds. We're going to talk about, because these are going to be a quarterly type of learn and lunch session for all of you guys as well. We're going to talk about a featured investment as well. And probably more importantly, what is the outlook? I know we had another rate rise yesterday, only 0.25, which is probably good for people with home loans, which is always a good thing. And I think, you know, 2.6%, we're still pretty low, but there's still some fantastic opportunities out there. And I suppose from our point of view, we want to continue to share those opportunities with you. So, which is fantastic. And I'm going to start with you, mate. Let's get into this. What are we sitting at? 1:36. So we're 6 minutes in, which is great. Mate, let's start with the CPI. Where is it at present, and why? So where's it sitting?
Yeah, look, at the moment, yeah, look, as we know, the CPI and inflation's a big concern, you know, in the markets, and everyone's talking about it. And we know that, you know, people are spending more, you know, interest rates are going up, and, you know, it's very high at the moment. So, but we know that, you know, the Reserve Bank and everyone else wants to have the rate at around that 2%. But, you know, to have it that low at 2% is probably unlikely. As we know, with the amount of spending at the moment, you know, inflation is really, really high. Rob, what's your kind of comments on inflation? I know you've got a...
Yeah, Adam, look, we agree. Look, we've, I mean, the same people that are telling you it's going to go back to 2% were the same people that said inflation didn't exist, and then it was transitory. So three strikes, you're out. Fortunately, from an investment management perspective, we've been preparing for inflation and the normalization of interest rates. So that's something no doubt we'll talk about a bit later. But yeah, I think inflation is here to stay. The supply chains around the world have obviously been impacted firstly by COVID and now the war. Anyone that goes to the supermarket or the petrol station can tell you that the price of things are going up.
Yeah.
You don't have to be a PhD to know that. The other interesting thing which is happening, I think, which is all things that our grandparents would have told us would happen, is that you can't be too reliant on someone external to your country to provide you the key goods and services that you need. That's a lesson that they learnt the hard way during wars. We forgot about it, and we're being reminded of it. I think you're going to see a massive clawback in the globalization, which has happened around the world. You've got, COVID was obviously the first thing that happened. The whole world was in a position where they had to get masks from China. And now that the war's happened, Europe's in just a complete and utter mess. Because they're struggling to keep the lights on because their energy was coming from one place. So these are lessons that we've all learnt the hard way again, and I think that by itself will keep inflation higher because it's just going to cost more. The last 20 years we've had let's just go to the lowest cost producer, i.e. China, developing world. That's changed. So a lot more stuff's going to be done here. We're going to have to pay more for things. The other thing that I'd say on the front line that I'm seeing is when I talk to real people, as opposed to listen to people on the Bloomberg or the Reuters, is they are telling me that their unions have not seen any increases because of COVID, and they're armed with we're going to go and we're going to ask for big increases in our wages. As soon as that happens, the inflation genie has gone. So if people think they're going back to 2%, well, you're probably looking forward to Santa Claus coming this December as well, because I just don't think it's going to happen.
Thanks, Rob. That's great comments.
Yeah, I'd agree. It's a new that we're going to be living with, and it's a very, very good point and great thoughts there. So, guys, let's talk about, and while we're going to get into some details, some other key things, we've sort of got bond rates keep going down, and we're going to touch on that later, but let's talk about cash and fixed interest rates. And while we've seen a sharp upturn in obviously our home loan rates, let's talk about savings rates. Have they kept on the same sort of trajectory?
Yeah, it's quite interesting, Paul. Talking to my clients, obviously the clients that are retiring or the clients that are near retirement are quite actually happy about rates going up because, their term deposits now are paying them 2 or 3% and they can get some decent returns. But obviously people that are, the young generation that want to buy their first home, obviously it's different. So it's very interesting going forward and what's happening in the markets. Clint, what's your thoughts in regards to the cash and everything else?
Yeah, obviously we're seeing the same thing, Adam, that cash rates are starting to creep up, not to the same extent of interest rates, but we're sort of starting to see around that 2.5% just for our call cash accounts at the moment, and over 3% for some of the term deposits. So hopefully they keep coming up because, retirees have unfortunately had to move up the risk spectrum for the last 16 years. So with rising rates, it may be a chance for those guys to actually start taking on a bit less risk and start getting a little bit more out of those risk-free assets of term deposits and cash.
Yeah, exactly. I see the same thing with my clients. So yeah, it's interesting.
Yep.
And I think it is good to see that they are rising, although they're rising a bit slower than the other interest rates that we've got to pay, but it's certainly good to see that they are rising. So let's take a quick look at let's say the Aussie share market and the international share market. Who would like to kick off on where the Aussie market is and then thoughts on the international market?
I think Rob can have a go at that for sure.
Yeah, sure. So, obviously it's been an interesting sort of period of time. And there's probably from an equity market valuation, I actually see there's two main things at play here. The first is we've seen interest rates go up. Now, it's important for people to understand that interest rates are they lead to the valuation of all other assets. And it gets back to, at its simplest, opportunity cost. Okay, so if you can leave your money in the bank and get 4 or 5%, you're taking an element of risk for that. So everything is priced around that. And obviously, as interest rates have fallen, asset markets have gone up. The second thing that I think is impacting upon markets, and it's, to be honest, I think it's still got a while to go, is basically expectations of earnings. The expectations for corporate earnings are still quite high, notwithstanding that the market's sold off. And whilst the market is going to contend with that, it's also contending with the new reality that rates are going up. There's other places to put your money. What you've seen in equity markets is you've seen the blue sky area. The things like the tech stocks and, spin a story and buy the stock and, watch it go up. That part of the market's been hardest hit because low rates are really the sort of really support that type of investment. And from our perspective, we've been underweight those investments. And so that's been obviously a positive to how we've performed. But in saying that, I think they're the two main things for markets. I think there will be a lot more volatility to come, but volatility is also the thing that provides us with opportunities. And the fact that inflation is around, that we spoke about earlier, what that means is that people have to, they know that $1 now will buy less in in a year's time. So what's important from an investment management perspective is we want to make sure that people's real purchasing power is staying the same, if not improving. So what we don't want to do is we don't want to go broke slowly, i.e. if we've got our money in the bank at 2% and inflation's running at 6%, you're actually losing 4% in real terms. You're going broke slowly. So that's not something you want to do for the long term. And notwithstanding the volatility, assets like equities and what have you, over the long term, they do provide good protection against inflation type scenarios.
Thanks, Rob. That's great. What about yourself, Clint? What's your view on the Australian and I suppose the overseas equities?
You're on mute, mate.
I was trying to think of my view on it. Basically, yeah, look, I take Rob's view that, interest rates are a big impact there. Markets are still nicely down from where they were a year ago. The cheap money has gone. So you have a look through things like the NASDAQ and that, and they're well down. There might be some opportunities starting to arise in the value side of the market for the first time in many, many moons. Which is where we've been playing lately and what's protected our portfolios over this last sort of year. We did take that value tilt. We were well away from those guys that rely on cheap money like your Teslas or your Afterpays or your WiseTechs, that sort of stuff. And that's the side of things that's been hit very heavily. But in regard to corporate earnings or any small business, it's not just like when we're talking about interest rates, it's not just mum and dad that's being affected by rising interest rates. It's going to be those small businesses as well, where if people don't have the money to spend, like a client that's a beautician, she's now got lower income coming in. Potentially her business loans are rising and she's getting squeezed from both directions, which is then going to have an impact on the overall economy and snowball into it.
Thanks, mate. I think it's just really important for our clients and listeners to know is that with the Shartru wealth model that we use with the MDA, the weighting towards shares is only around that 40 to 55% sort of mark. It's not 100% in the market. So we have a risk-adjusted portfolio. It's not just shares. So I know we are talking shares at the moment because it does hold a part of our portfolio, but we have a lot of investments in the MDA that aren't aligned to shares. But we'll go through that in more detail later. Thanks, Paul.
Yeah, brilliant. So where does property sit in here then? So we've spoken about a few things now. There's probably it's been an interesting 12 months or so, depending on where you are, I suppose, as well in the country. But where do you guys sit in terms of property?
Well, I think with property, we in the MDA we have a holding of property, so we definitely have property. There's obviously different parts of property. You have residential, you have commercial, industrial, so Rob, might hand it over to you in regards to, talking about the property that we have through the MDA. It's normally around that 20 to 30% mark.
Yes, absolutely. And your point, Adam, was it was a very valid point. Diversification, uncorrelated assets, that's what the whole thing's built upon. And especially at periods of time like now, diversification is really, really important. That was a great point. In regards to the property, we're mainly in commercial type properties. We have done other things like student accommodation. We've done things like that. The good thing about property is that all the rents are ratcheted to CPI. Okay, so it's basically a natural hedge against the inflation. So what we're actually seeing in property markets at the moment is there may be a little bit of a softening in values because interest rates have gone up, as we discussed earlier. But the good thing about it is because inflation's running, right, that means that their rents are getting put up. So the most important thing is obviously that those businesses can continue to afford to paying the rents. And that's from a selection criteria. That's one of the things we consider before we go into these assets. And that's where we love assets. We love tenants such as the government, for example, because they'll pay their bills no matter what. So inflation's got a very big part to play property's got a very big part to play in this environment, and it's a core part of the portfolio.
And it's an interesting one because it's a good one to sort of segue into a little bit in terms of whether it's the Australian share market, international share market. We've spoken about cash rates and so on. Balance is always an interesting one, isn't it? In terms of, let's say, in a managed fund sort of sense, in terms of balance, what should that look like?
Yeah, well, as I sort of said, at the moment, I think diversification really matters. I mean, it always matters, but it sort of matters more when it matters, if you know what I mean.
Yes.
At the moment, I think diversification is a really, really important for people to have, because if you get caught in the wrong sorts of assets, you could be in a whole lot of mischief. From the perspective of commercial property and how much do we want it, even going back to the very simple analysis that we always work off, we want people to maintain their real purchasing power. Okay. So when we use the scenario of if you're earning 2% in the bank and inflation's running at 6%, well, that's not going to work for you. The good thing about property is, well, we're earning 6s, 7s and 8s in real income. Okay, so, and the fact that income's ratcheting up with inflation. So that means in real terms, investors are maintaining their purchasing power from these assets. So it's got a very important part to play, but it's like all things. It's just one leg on the chair, and it's important to make sure that we don't go too heavy on one thing or another, because at the moment, diversification is really, really a key feature.
It's a good point. Anything you want to add there, Adam?
Yeah, look, I definitely with property, it's great to have that as part of the portfolio. I mean, our clients love property. I think it's just an Australian thing that, Australians love to have property. And where I can tell them the story with our MDA, we use, for example, AMP Capital, that they hold assets like, Coles and Woolworths and the Gasworks and their debt to equity ratio is only about 10%, only 10% debt. Clients get very comfortable with that. And these guys are going to pay their rent. So it's a very secure asset, good income, and it really fits in well with the whole, property, some shares, diversification, as Rob said, diversification in this market is key.
Yeah, well said. So guys, we touched on it before in terms of bonds. Are you guys okay to jump into a little bit how it works and maybe how they are positioned?
Yeah, sure. I think probably one of the things as a committee we've been tackling with is for quite some time is when interest rates, they call it normalized, but when interest rates go back to normal levels, right? And when you go from zero to back to something that's not zero, that means interest rates are going up. And long story short, what that means is that the value of the debt, the market value of that debt will then decrease. And that's basically what's been happening over the last 12 months. Fortunately, we had the positioned in such a way that Well, I'll just give an easy example just to demonstrate the fact.
Right.
Let's just say I borrow $100 off Adem, and I'm going to pay him 10% interest for the next 30 years, right? And I'm just going to pay him the interest bill. So every year I've got to give him $10. But then let's just say interest rates move, right? And then basically Adem doesn't want to carry my debt anymore. He wants to sell it to Paul. But interest rates have gone to 20%. So the amount of debt that I'm paying is fixed. It's the $10. So the only way we can get the 20% yield is by the value of the debt that basically Adem sells to Paul reduces. So he's selling his debt for half to make sure that my interest payments are equal to the 20% rate. So that's the impact. And obviously if it's over 30 years, well, the impact's around for 30 years. If that was a 1 year contract, well, we've got a bit of pain for 1 year, but then we can start again, right? So basically what we did with our portfolio was we basically made sure that we had what we call very short duration. So we basically made sure that any problem we had was for a year or two. And that's held us in really good stead because we've still been getting our interest and we haven't had that revaluation. What's been happening in the bond market more generally, though, is when money was cheap, lo and behold, all the governments and all the corporates were running out borrowing as much money as they could and locking it away for very long periods of time. It's human behavior. That's what exactly what they should have been doing. The problem was the people that have lent them this money have now, with interest rates going up, have seen that value of that debt re-rate, and it's much lower than what it was. And that's the problem you're seeing in the market at the moment, which I'm glad to say that we've avoided. But in saying that, that has a huge impact because the debt market is a huge market. It dwarfs the equity market. It dwarfs property markets. And that's why you're seeing a lot of volatility in the other markets because debt, leads into everything else. So yeah, interesting times.
Yeah, well said, well said. And that's the thing about these sorts of things, I suppose, because it's the learning aspect. I know I say it a lot, but what you don't know, you don't know. So the ability for, sort of Adem to have you guys on here to share these sorts of things, whether it be the bond market, whether it be the managed funds and the balance, it's what we don't know, but that's why we've got to learn and educate ourselves to work out which way to move forward with the uncertainty of what's going on as well. So it is great. So thanks, guys. It's very, very good information. Look, each quarter as we're doing these now, we want to highlight call it a featured investment. So I'll probably throw it at Adem, between you, Rob and Clint can work this out. What's going to be our featured investment for this quarter?
Well, I think we're talking about the bond market.
Yeah.
So I can give some examples there of what we've done. As Rob said,
Right.
There's inverse relationship with bond interest rates and bond prices. And we took that decision 18 months ago or so, Rob, would it have been, to remove the duration? And just as an example, for the 12 months to 30 June, Australian bond prices fell around 10%, international similar, sometimes down to 17% for the high yield stuff, whereas ours with the low duration has basically stayed steady. We've avoided those falls, which we're quite happy around that outcome.
Thanks, Clint. Yeah.
Anything more you want to add there, Adem?
Yeah, look, I think that's the beauty of the MDA and having these guys, investment team behind us, is that they kind of look to the future and they're very positive about what's happening and what they're doing. It's not like they're just throwing the money into a managed fund and just hoping for the best. The whole idea of the MDA is to really help our clients so they can really see that we're working for them. We have the investment team behind them. We're not just putting it all into shares. The portfolio has property, has fixed interest, has private equity. It has shares. So it's a real diverse portfolio. And I think more importantly is that these guys are making changes when changes need to be made. So if we need to go to more fixed interest, more cash, these guys will make those changes for our clients. They can just don't have to worry about. We don't have to kind of go if it's in a managed fund or if it's in with like a big, I suppose, industry fund. They're just plonking them into big managed funds and hoping for the best. At Shartru Wealth, that's not the case. So that's what I love about working with the MDA and working with these guys is that our clients know that we're, it's a risk adjusted portfolio, and we're really working for our clients.
Yeah, I think that's a really good point, Adam. When you got big money managers, like guys that manage a lot of money, guess what they own? They own everything, right?
Yeah.
So when I spoke about all the governments and the corporates have gone out and borrowed a heap of money at long terms, right? Because that was the smart thing to do. Well, all of these people that have got all the money then went and bought it, even though that wasn't the smart thing to do, right? Because they've got no choice.
Yeah.
Whereas what the approach we took wasn't necessarily that we were seeing the future and going, oh, that's going to happen. We suspected it was going to. When it was going to happen, we didn't know. But what we did know is that why do we hold debt in a portfolio, right? We refer to it as the defensive portion of the portfolio. So the last thing we wanted was the defensive portion of our portfolio losing 20%, because they're conversations we don't want to have with clients, right? So we specifically sort of tailored that strategy to what we wanted our clients to have, which was, well, okay, let's avoid that scenario because we don't want the downside, especially when, to be honest, when interest rates are so low, they couldn't get much lower. So we were leaving that potential upside on the table because we just didn't think it was in the best interest of the portfolio as a whole when it came to our clients. And they're the sorts of decisions that we're making on behalf of investors, as opposed to just, let's just go wherever we have to go and, because that's what we need to do. That's not what we're about.
Fantastic.
Yeah, well said. So what does the future look like, guys? What's the outlook look like for the future? I know you don't have a crystal ball, but what do you guys think?
Well, I certainly think, I've been in the markets now and been doing this job for over 30 years, and markets go up and down. But one thing we do know is that as long as you've got the right portfolio, cream always rises to the top. So it's all about having the right, the right property, the right shares, because when things do turn, and things will turn, everything goes in different styles. And I'm very confident of the future, and I'm very confident of our investment team getting it right. And look, when we do our clients' portfolios and we do the retirement plans, and we do that with all of our clients, and we show them where they are today, where they'll be in the future, and how retirement looks, we base it all around a conservative figure of 6%. So we just know we have to try and target, if we can target that 6%, and we know that over the long term, not the short term, we know over 1 month, the last 12 months has been, crazy in the markets, as we know. But, over the long term, these things happen. I've been through a GFC, and I've been through the computer tech stuff and everything else, but things do turn, and I'm sure the markets will turn as well. And as long as we've got the right assets in place, and I'm sure that these guys are looking after our investors, make sure they're top shelf, I'm sure that for our clients, we're going to be able to achieve their goals in the long term. What's your thoughts, Rob?
Yeah, look, I agree. Look, there's a lot going on in the world, obviously. It's probably an understatement.
Yeah.
In saying that, what we do doesn't change, right? What does change is probably the swings and the excitement and hoo-ha. But basically, it gets back to what we do is the same thing that we've always do. We sit there and we say, okay, what are the things we want to own? What are the things we don't want to own? Where's the risks? How do we mitigate these risks? What is it that our clients actually really want? Do they want to be in these sorts of things that are potentially going to give them huge returns, but also potentially huge losses? The questions remain the same. They are always the same questions. And the good thing about investment markets moving is that it always throws up opportunities. And whilst there is definitely things you want to avoid, there is also, on the flip side of that, there is things that are really good value. So from an investment management perspective, I'm actually excited to have markets back. You can actually go and talk to investment guys and they'll give you different opinions. Whereas, to be honest, the last 10 years, it's basically central banks have just been dictating what happens in markets, which is that they've been going up. So I, for one, am happy. And I'm also happy for savers, people that are in retirees. Retirees can go back to actually getting an income without the level of risk that they were taking previously. And I think we haven't heard the last of that. Definitely not the way we manage money, but there's a lot of people out there in the market that have retirees in very large amount of risk. And I think that that will play out over time, and that's not going to be good. And it's a credit to Adem and people like him that are making sure that their clients aren't in that boat.
Well said. Well said. To all of you that have joined us, if you've got any thoughts, comments, questions you would like to ask, of Adem, Rob, or Clint, please throw it into the Q&A. We'll take some questions before we wrap up. We'll probably, in another 5 or so minutes, we'll probably wrap up anyway. I'll let these guys have maybe a final word or a parting comment as such. But if you've got any questions you'd like to throw out based on anything we've spoken about over the last 30 minutes, please throw it into the Q&A and we will look at that. Gents, I'll go to you guys for some parting comments as we sit here on the 5th of October. Hard to believe it's 5 October. Jesus Christ.
I think one thing, Paul, I just wanted to make sure that all of our clients and everyone listening in that, today's all about general advice. And, obviously we're not taking into account their personal circumstances. If they want to obviously get some advice, please make an appointment to see me or Leslie at Virtual Financial, and we'd be more than happy to give them some advice and do a plan. And, thank you, Paul, for hosting this. Much appreciated. And we're really looking forward to providing information for our clients like, Virtual Financial. We're trying to make financial advice affordable for people. Once again, with what's happening in the industry at the moment, where we're losing so many advisors, the Royal Commission, the way ASIC are going about, having 100-page SOAs and everything else, it's really making it difficult for clients to get financial advice. And the whole idea for us is to hold these sort of presentations and quarterly updates, and monthly updates that we do to try and educate our clients and listeners so they can, take action.
Well said. Rob, parting comments?
Business as usual, Paul.
Good to hear. All right, Clint, got anything to share, mate, quickly?
No, I've got nothing. I mean, we'll continue to try and keep an eye on what's going on in the world and adjust portfolios with that risk-adjusted return.
Yeah, brilliant. Keep doing what you're doing. That's the key thing, is you're doing a very, very good job, and we're very appreciative from a Virtual Financial point of view. So thank you. Doesn't look like there's any questions, which is probably a good thing, because that means you guys have covered everything, which is a good thing. Ladies and gentlemen, again, for all of you that have tuned in, again, don't forget, if you want to, again, see our continued updates, please tune in on our LinkedIn or our social channels. So via LinkedIn or Facebook, if you wanted to jump in there, like our pages, that's probably the best way where you'll get continued updates as well, certainly with events like this, or certainly with the podcast series that we've created. Otherwise, thanks for joining us. We certainly appreciate, Adem, you being here as the head of Virtual Financial, and obviously Rob and Clint as well from Shartru Wealth. Thanks for joining us, and enjoy the rest of your afternoon.
Thanks, guys. Thanks, Rob. Thanks,
everyone.
Thanks, guys. Bye-bye.